Realty Income is a real estate investment trust that continues to prove naysayers wrong about their current situation and where they're going. Despite some people being pessimistic about this company for years, they've continued to post really good results and are proving themselves to be a safe haven in our current market environment. Over the past few months, Realty Income has been delivering growth in nearly every important metric for a REIT, and we're going to take a look at that today. We're also going to debunk the largest ongoing criticism surrounding this company and where Realty Income appears to be going in the future. To start things off, investors have been treated to some really great news regarding Realty Income's dividends. Their stock has increased their regular monthly dividend 3 times in just a little over 3 months. This company has grown their dividend every quarter for the past 27 years, and in December, they grew their dividend by their typical amount that they usually do. In February, Realty surprised investors with an additional increase of 1.5%. It was too early for their next quarterly increase, so this was just an additional bonus. And then in March, this company grew their distributions yet again by the typical amount, so that's 3 increases in their distributions in just a little over 3 months. On February 24th, this company released their full year 2024 results and the results of their most recent quarter. Currently, their AFFO dividend payout ratio is sitting at 76.71%, which is still within the conservative range of between 70 and 80%. Their occupancy rating was sitting at 98.7%, which was unchanged from the previous quarter and up slightly from this time a year ago. Realty's long-term average is 98.2%, so they're still doing much better than what's typical for them, and they're doing much better than the REIT occupancy average of 94.2%. They also reported having $3.7 billion in liquidity, which is very conservative. Overall, despite being slightly off when it came to meeting FFO estimates, we can see this company and its dividend are still in a very healthy position and they continue to grow as normal. However, we do need to focus on some arguments that have been going around against this company. Around 2 years ago, I noticed there was a growing argument against Realty Income that was becoming more popular. It wasn't the first time this point was made, but it was an argument that was gaining more traction among some REIT investors and enthusiasts. The argument is that Realty Income has just become way too big, and as they keep becoming bigger and bigger, there's not going to be enough good deals for them to acquire more properties to keep growing their dividend. What a lot of people don't realize is that, yes, Realty Income is a very big REIT, but they don't even come close to owning all the properties that they actually could. Despite owning 15,621 properties as of their most recent quarter, they're not running out of growth opportunities. They're currently the 7th largest REIT in the world, so they are big, but there's still plenty of opportunities for them to expand. Some people have taken issue with the fact that they have expanded into new sectors that they never used to before. Realty Income has historically been a retail REIT, which is a company that owns convenience stores, grocery stores, and those sorts of businesses. But for example, Realty Income acquired a casino resort back in 2022, the Encore Boston Harbor. I remember the day they announced this, and it did turn a lot of heads among their shareholders. They've also expanded into a couple of other unusual sectors, such as vertical farming. Because this management team has no prior experience in these sectors, some investors think it's too risky for them to be expanding into these whole new areas. But it's really important to note that, regardless of the property type that they're looking at, Realty Income follows the exact same format when it comes to property acquisitions. In order for them to even consider making an offer on a piece of real estate, it has to meet a long list of requirements. That would include things like ensuring the company that's renting the property is performing well financially, its location is solid, and they can project growing their rent sufficiently enough. As long as they can do that with a property, then I see no issue of them going into new sectors. Although it was a surprise, the Encore Boston Harbor was a good investment for Realty Income for a couple of reasons. The lease agreement for them is 30 years, which is more than 3 times as long as a typical property owned by Realty Income. They're also going to be able to grow their rent at a much faster rate compared to what's typical. With these flagship casino resorts, if they've been performing well, then they can be great investments. It's also why I'm a big fan of VICI Properties. That REIT owns a lot of Vegas casino real estate, and they have their tenants locked into very long leases, and they can grow their rent at a significantly faster rate compared to what's typical for a REIT. As long as Realty Income sticks to their acquisition strategy, I don't see an issue with them expanding into new property types. There are good deals that exist in all sectors, and they've been doing so very carefully. Most people who make the argument that this REIT is getting too big don't even take Europe into consideration. Realty Income started expanding into Europe in 2019, and today they have $12 billion worth of properties in this continent. According to this company, there's currently $8.5 trillion worth of opportunities that exist for them. So that means that, as of the making of this video, Realty Income owns 0.001% of all the potential real estate that they think they could own over there. Does that sound like a company that's going to run out of growth opportunities anytime soon? They say their goal is to become the biggest REIT in the world, and they haven't even expanded into any additional markets like Canada or Australia. I wouldn't be surprised if this company starts acquiring more of these large properties like the Encore because they can raise rent at a much faster rate. But how about the argument that Realty Income is becoming riskier due to some tenants closing their locations? Over the past year or so, a number of Realty Income's largest tenants have been announcing their intention to close a sizable number of their stores. Walgreens was planning on closing up to 25% of their retail stores, Dollar General announced that they intend to close 800 of their locations, and CVS said they intend to close 300. I did the math in a previous video, but I basically calculated how much of their portfolio would be vacant in a worst-case scenario for each company that's announced closings. Walgreens is closing the most out of all the other companies listed that are owned by this REIT. So in a worst-case scenario, if Realty Income lost 25% of their Walgreens locations, that would only be 0.4% of their portfolio. And I calculated that when Realty Income had a smaller portfolio, and that's assuming that Realty Income didn't do their homework and they didn't pick any good Walgreens locations. They're only going to close the underperforming stores, and Realty Income avoids acquiring those kind of properties. This is not a big issue, despite what some people think. Yes, a lot of companies have announced closing down locations, but it's not going to negatively impact this company's payout ratio. But how about Realty Income's lackluster share price growth? It's been pointed out that shares of the stock haven't grown too much over the past decade. This is a terrible reason for not considering this stock, and I would argue that anyone who raises this argument either has short-term memory loss or they just haven't done their research. If we pull up this stock's share price chart, we can see that back in February of 2020, it was trading for $80 per share. After that, we had the COVID pandemic, which caused the share price to go down significantly, just like the rest of the market. Between March of 2020 and mid-2022, it was recovering and it was making really great progress. But then interest rates started going up, which negatively impacts REITs much more than all other types of companies on average. That is the reason why the share price of O has been performing so poorly since mid-2022. When we do get rate cuts later this year, it's going to greatly benefit this entire sector. And Realty Income, by the way, is not the only company that's been facing this issue. Look at the Vanguard REIT Index Fund, ticker VNQ. You can see that a lot of REITs have been performing pretty poorly, all just because of higher interest rates that started in 2022. Besides, Realty Income has grown their dividends significantly in the past decade, and their property portfolio has increased threefold since 2015. This stock is still at a very good discount, and the market will eventually wake up to how great it is, just like it was before COVID. This company targets 5% AFFO growth per year, which has been their average since the 90s. In 2024, they grew by 4.8% in terms of AFFO, so everything is still moving along just fine for Realty Income. Do not let the naysayers discourage you from buying a solid monthly dividend stock like Realty Income. But with that being said, thanks for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.